Joining us now is Donald Kohn. He's the Senior Fellow of Economic Studies at Brookings Institute, former Vice Chairman of the Federal Reserve Board of Governors. He used to have that job that Richard Clarida had. Welcome back to you. So how do you think about whether China's lost economic activity will just bounce right back?
Well, I think that's probably the most likely outcome, but there's certainly a risk that it doesn't. So obviously, this is a terrible human tragedy and is having a major effect on China and rippling from there across the global economy through, as Rich said, through supply chain disruptions, through reduction in exports to China, through tourism being cut down around, particularly around Asia. I think the most likely outcome is that they get their arms around this thing. Gradually it dies out. The Chinese economy recovers in the second quarter, or certainly the second half of the year, and it leaves a very small imprint on global GDP. But there is a downside risk here that it becomes a pandemic, so it affects more countries over a longer period of time.
Does it feed back to the U.S.?
I think certainly a little bit. The question is for how long. So if you think about it from Rich's perspective as a monetary policymaker, I think Jay Powell had it right. He said they'll need to judge whether the shock to the U.S. economy, the effects on the U.S. economy, are persistent and material. So I think right now it doesn't look like they're material. Might be a small effect. But that could get larger. The persistent part is also very important for monetary policy, because if things recover in China and China begins importing more and tourism recovers and supply chains are reestablished in the second half of the year, then easing monetary policy to counter a temporary shock like this would not be appropriate. It wouldn't do anything to the shock, and the easing of monetary policy, which has effects on the economy with a lag, would come in just as everything was recovering. So I think the Fed's right to monitor the situation closely, but I think the best guess is it's not really something that monetary policy is appropriate to react to.
Well, and yet, Don, like here we are again, where the market is pricing in a Fed rate cut this summer. So if you were still on the Fed, how likely would that be from your point of view?
I agree with the other part of Rich's interview this morning with Steve, that it's not. My best guess is that interest rates would remain pretty constant over the year. I think the economy, the underlying economy, is growing well, about in line, maybe even a little faster with our potential. Inflation is lagging the Fed's target, but I think it's reasonable to expect that it will come up towards the target and to the target as the FOMC does at current interest rates. I would emphasize there's a huge amount of uncertainty around a prediction like that. And I think we need to recognize all kinds of things could throw that off. But that would be my best guess right now. I think what the market has priced in, and appropriately so, is that if there is a change in policy, it's more likely to be down than up. And I would guess that's what they're pricing in, that probability, rather than a certainty of a policy ease.
Don, with the election in mind, how strong do you expect the economy to be throughout the rest of this year?
Well, without the election in mind, Wilfred, I think it'll be fine. I think people are predicting 2% type growth, similar that we had last year, maybe a little higher, a little lower. That's right in line with potential. I think employment growth will remain good. Incomes will continue to increase. Consumers whose debt loads are pretty low relative to their income right now, and certainly their debt servicing is very low with these low interest rates. Savings rates are already pretty high. So I think supported by income growth, supported by financial conditions that are very, very accommodative, both in interest rates and in equity prices, wealth, consumers will continue to spend. The big question mark is business capital spending. That's been weak. that has not contributed to growth. It'll be interesting to see whether that begins to pick up because, let's say, trade tensions are a bit lower than they were last year. Uncertainty may be a little bit lower. So that'll be one thing that could push the economy to a bit stronger. But right now, we don't have any indications that capital spending is picking up.
Donald Kohn, thanks for joining us.
You're welcome. Good to be here.